Hey everyone, thanks for joining today. My name's Chris White. I'm an investment analyst with 5i Research, and today we're going to be going over the top questions that we received this month. Martin asks, I have space for 3 growth stocks in my TFSA. Looking at various sources, I found the above suggestions. Ideally, I'm looking at 15 to 20% or more of annual earnings growth for the foreseeable future. How would you rank the above stocks without regard for sectors, with a short explanation for the top 3? Also, any other suggestions? Thanks. Our answer here is that we would rank Kinaxis, Nuvei, Descartes, OpenText, Thomson Reuters, CGI, and Dollarama last. So tech ranks high with an expected recovery for us. Kinaxis we like for its long-term approach and the fact that it hasn't issued new shares since its IPO. It's a global player which adds potential. Descartes has been solid for a long time, and the logistics sector's growth rate is improving. Nuvei we like fundamentally, but it was beaten up so badly that it ranks high for recovery for us, and its short-term momentum has been very solid. For growth, we could add Aritzia, Do, which is BRP, BN, which is Brookfield, and GSY, which is GoEasy, to this list. So we continue to like this ranking, and especially after the strong earnings that we've seen from Kinaxis, Nuvei, and DSG, the top 3 names there. We feel that with the tech sector's sluggish performance over the past year, it really has the ability for a strong recovery. And these are all names that we're quite comfortable with. And the 4 extra names that we added at the end, Aritzia, BRP, Brookfield, and GoEasy, we particularly like as well. And we think that these could do quite well this year and into the future. Okay, so question number 2 comes from Ronald, and Ronald asks, I have very little exposure to consumer cyclicals in my portfolio. I'm considering taking a small position, say 2 to 3% in Canadian Tire. It has a 4% dividend yield, and some analysts seem to like it. Question, is now a good time to begin taking a position in consumer cyclicals, and what are your thoughts on CTC? Are there better options? So our answer is that we feel, considering a long time frame, consumer cyclicals are presenting a good opportunity today. Cyclicals were one of the worst performing sectors last year, and given an eventual upswing in the economy, cyclicals can perform quite well here. We would be comfortable stepping into CTC.A, which is Class A shares. It has a strong yield, solid 5-year sales and earnings growth rates, and it trades at about 10.2 times forward earnings, which is well below its 10-year average of 14 times plus. Some alternative consumer cyclical options include Do, which is BRP, ATZ, which is Aritzia, and Doll, which is Dollarama. So what I'm going to do, I'm going to pull up a snapshot of some of our favorite metrics for Canadian Tire, and we'll go through why we like this name here. Okay, so we mentioned our comfortability with Canadian Tire, and so here we want to look at some key metrics that we're looking at for Canadian Tire to demonstrate why we're comfortable with this name. The very top here in green bars, we can see its EBITDA over the past 20 years, and its EBITDA has been climbing higher alongside its share price, which is the red line. Next in the section below, we can see its 1-year revenue growth rate. It's been hovering around a range of 9% over the past couple of years, which is a step up from over the last, the previous 18 years before that. In the section just below that, we can see net profit margins. Those have been kind of consolidating around a range of 6%, which is in line with its historical average. So although net profit margins have fallen over the past couple of years, it's very much in line with its long-term averages. In the section below that, we can see that its forward PE ratio has been trending lower over the last several years, and this to us demonstrates its fundamental strength. So even while share price has increased over the last several years, its PE has gone down, meaning that earnings are growing faster than share price. And the last section here is its dividend yield. We can see that's around 4%, and that's just been climbing higher over the past 20 years. Okay, everyone, that's it for today. Thanks for stopping by, and please remember to like, subscribe, and share this video if you found it useful, and head to the 5i Research website where members can ask questions regarding individual stocks or the market, find research reports on Canadian companies, receive bi-weekly newsletters on the market, view analytics on their own investment portfolios, and much more. Thanks again for watching, and we hope to see you next time.